love the channel and find it useful in becoming a happy retiree. Subscribe today. There's an awful lot to talk about and worry about in the world that we live in. And I'm here to try to help you keep it in context, because if you really just surf the web, let's say, and you went to CNBC.com or Bloomberg, which I would say Bloomberg is one of my favorite portals that seems as objective or more objective than anyone else, let's put it that way. And it really is financial news, economic news, how politics plays into economics. If you were to just go and look at CNBC and you click on a few articles, the next thing you know, you're tracked by all of these different newsletter services that are going to scare they're just going to scare you. And because there's a lot of scary information around the world. You know, we're worried about oil prices. We're worried about, we can't seem to generate inflation. So there's worry that we're having at some point deflation. And then you worry about, well, wait a minute, what if wages do go up? Well, wages going up could cause a recession. When's that going to hit? We've had this low, sleepy, low volatility, low volume stock market. Well, when's that going to break? You know, markets just don't go up forever without corrections. We really haven't had one this year. We've gone an entire year without a 5% correction in markets. So you have investors that, to some extent, they get lulled to sleep during periods of time like this, and invariably, and at some point, you get woken up. So again, more than a year, more than an entire 365 days without a 5% pullback in the S&P 500. So there's a lot to worry about, and then you start clicking around on the interwebs, and you end up getting followed now, because now your cookies and your activities suggest that you might care about the economy, you might care about stocks. Well, guess what? If you have a 401k, yeah, you do care. And then you get fed all the scary stuff around the world, and if that happens, it can be disconcerting, and it's hard to just block it out. You know, we're designed as human beings to actually look out for our well-being, and a giant part of today's modern world is to look out for the well-being of the money that we've saved, the economic side of the balance sheet in our life. So it's hard to ignore all the scary things that are out there, and it makes investing. It's by far the most difficult part of investing, is the emotional side of feeling comfortable with being invested and not being too aggressive, not being too conservative, because you can very simply just leave your money in cash, never worry, but then you have the anxiety that you're being left behind. And if you've done that in the last couple of years, you've missed a 200+% S&P 500 run. The Dow's up well over 200% since the Great Recession ended. And that hurts if you've been sitting in cash and doing nothing. And then you start to say, well, wait a minute, what do I do now? How do I get back invested? Do I get invested today now that the market's hitting these all-time highs? And that's a tougher question. That's a more difficult economic problem and investing problem to solve. The answer, in my opinion, goes back to balance and income. Income comes from three places: dividends. They come from various stocks. Whether they're companies that are going to be doing repatriation when taxes change or not, or these are high-yielding companies like the telecom companies and the utility companies and the MLPs, the pipeline companies that pay in the 3.5% to 5.5% or 6% annual dividend yields. That's a big part of the answer to striking some sort of balance that's not overly conservative or not overly aggressive, to get to the point where, yes, when we do have a correction, what happens? Especially if you're getting close to retirement, most families really should not have full exposure to the stock market. So there's this balance of dividends, and then we get interest from various bonds. Well, what about those bonds? Aren't interest rates going up? Well, the answer should be yes. As the Fed ratchets rates up, there's another Federal Reserve meeting this week on Wednesday. What are they going to do? Well, they probably will stay put here for this particular meeting, but then raise in September. At least that's what the market expectations are. And then what does that do to your fixed income or your bonds that pay interest? And then we've got the pipeline companies and REITs and these closed-end funds, and they pay out distribution. So I just named three separate ideas that come together as cash flow. Dividends and interest and distributions, they equal a cash flow. You're going to have a portfolio, some sort of yield that is somewhat separated or independent of market action. So if you have a cash flow, that's independent. You get a dividend from Home Depot or a dividend from Apple or Microsoft or Southern Company. That should not depend on the fluctuation of the stock price. In certain cases, if there are extreme fluctuations, that means there's probably something wrong with the company, and maybe they can't pay dividends. But for a healthy company, stock prices can go up and down by 20 and 30%, and the dividend still doesn't change. The amount they pay out in cash flow still doesn't change. So that's the comforting piece of having an overall income-oriented strategy. And you want to get that income from a lot of different places, not just one tributary running into a giant stream of income, but multiple tributaries that all combine to create a new paycheck once you get into retirement and you stop working for a living. Hi, I'm Wes Moss, and thanks for taking a minute to hear about what's so different about my new book, You Can Retire Sooner Than You Think. So unlike other retirement books, this book will give you a step-by-step guide, whether you're in your 20s or 30s or 40s or 50s, to learn from what these successful and happy retirees did to get there. I hope you enjoy the book, but more importantly, I know that it'll help you retire sooner than you think.